Welcome back to The Uncomfortable Truth, the podcast where we dive deep into the unseen variables that truly shape our success. I'm your host, Alex, and today we are tackling the single biggest saboteur of financial dreams, trading anxiety, that pit of your stomach fear that hits when the market moves against you.
It's the silent killer, Alex. I'm happy to be here. I'm Ben, and as a former institutional trader, I can tell you that I've seen more accounts and careers wrecked by fear and euphoria than by bad technical analysis. It's what separates the pros from everyone else.
That's a powerful statement right out of the gate. We spent so much time studying charts, reading the Fed reports, memorizing indicators, but you're saying all of that expertise, all that technical knowledge is worthless if you haven't mastered what's happening in your own head.
Exactly. Think of it this way. You can have the most finely tuned race car in the world, but if the driver panics and slams the brakes at 200 miles an hour, the car ends up in the wall. The engine wasn't the problem, the driver was. In trading, your mind is the driver. We're fighting a psychological war, not an algorithmic one.
Right. So let's start with the why. Why is the market such a perfect breeding ground for anxiety?
Because the market, by its very definition, is the realm of uncertainty. Our primal brain, the one that kept us alive on the savannah, hates uncertainty. It sees a sudden drop in our account balance as a genuine threat to our survival. Anxiety in this context isn't a weakness. It's a natural biological response. The problem is that it's completely counterproductive to rational decision-making in a financial environment.
That's fascinating. You mentioned that over 80% of failed trading decisions stem from emotional factors, not technical errors. How does this anxiety actually manifest in a trader's behavior?
It manifests in two truly destructive forms, which I call anxiety by omission and anxiety by action.
That distinction is key. Let's break those down.
Anxiety by omission is paralysis. You see a perfect setup. It meets all your back-tested rules, but you freeze. You don't enter the trade because you're terrified of the possible loss. Or, conversely, you enter, the trade goes slightly positive, and you exit prematurely because you're afraid of losing the small gain, only to watch the price rocket higher without you.
The classic should have, could have scenario.
Precisely. Now, anxiety by action is the opposite. This is what makes people overtrade, chase the market, or the cardinal sin of moving your stop loss.
Oh, the stop loss movement. Every trader knows that feeling. It's just a temporary dip. I'll move my stop a bit further and it will definitely recover.
That decision is pure, raw anxiety. It's the brain desperately trying to avoid realizing a loss, which is perceived as pain. It also leads to oversizing, where you take on a position much larger than your capital safely allows, ensuring that even a small market movement triggers sheer panic.
It seems like we're always oscillating between two main forces. The source material refers to them as the two horsemen of the financial apocalypse, fear and greed.
They are the yin and the yang of market emotion, Alex. They are inseparable and incredibly potent. Fear is what makes you sell at the absolute bottom. You panic dump your position when the price is lowest, right before the rebound. Greed, on the other hand, compels you to buy at the very top, driven by the euphoria of not missing the party.
Can you give us a good analogy for how we should view these?
I like to think of greed as a helium balloon. It's wonderful and it lifts you higher and higher in your P&L, but if you keep filling it, it will eventually explode. You have to know when to release the string. Fear is the heavy anchor. It keeps you fixed in one place, preventing you from navigating towards opportunities, even safe ones.
So the expert trader isn't someone who eliminates these emotions, which is impossible, but someone who channels them.
Yes, through a rigorous system of rules that act as containment dikes. And part of that system is understanding your invisible enemy, cognitive biases.
The shortcuts our brains take to simplify information. Which ones are the most destructive in trading?
Two immediately come to mind. First, confirmation bias. We only seek out information that confirms what we already believe. If you bought shares in company Z because you think they'll revolutionize AI, you will only read news articles praising their potential. You will actively and intentionally ignore reports from, say, a reputable analyst or even a systemic risk analysis from the IMF that points out their massive debt problems. You only want to hear the good news.
That must feel comfortable in the moment, but it's disastrous for risk assessment.
It's a comfortable, predictable path to ruin. The second is anchor bias. This is when you fixate on the very first price you saw for an asset. Let's say you first looked at Bitcoin when it was $20,000. It doesn't matter if the fundamental value has shifted dramatically, your brain anchors to that $20,000. You refuse to buy it now at $60,000 because you think, that's too expensive. I remember when it was $20,000. Or if you bought it at $60,000 and it drops to $40,000, you refuse to sell because you're anchored to the higher price.
That's a powerful insight. You're essentially fighting the market with outdated information because of a mental shortcut. The takeaway here is to formalize our hypothesis before we ever execute the trade.
Absolutely. I have an actionable tip for everyone listening. Before you hit buy or sell, write down a simple sentence in your journal. My hypothesis is X. If Y occurs, my stop loss activation, my hypothesis is wrong. And I accept it without drama. That simple act forces a moment of cold, rational acceptance.
The emotional bulletproof vest, the trading plan. This brings us to the practical solution, the trading plan. The document describes it as the emotional bulletproof vest. How do we build one that's truly panic-proof?
It's not about meditation or positive thinking. It's about a trading plan so robust and so respected that it leaves zero room for emotional improvisation. Who would trust a pilot who decides the altitude and destination mid-flight? Nobody. You are the pilot of your capital, and you must have your route defined before you turn on the engines. This is the foundation of your experience.
And a huge component of that foundational work is backtesting. This is applying your strategy to historical data.
Backtesting is critical because it gives you something far more valuable than a guarantee of future gains. It gives you statistical knowledge. When you know that your strategy over 100 past trades has a 60% success rate and a 1 to 2 risk-reward ratio, the individual loss stops being a traumatic, terrifying event. It becomes a simple, expected data point in a long series.
You remove the emotion by introducing statistical certainty.
Precisely. If you know that out of every 10 trades, 4 are expected losses, when a loss hits, you don't panic. You just check one of the boxes. That cold mathematical perspective instantly eliminates a massive amount of anxiety.
Let's get to the true heart of the bulletproof vest, risk management. This is where the rubber meets the road. What's the golden rule here?
The golden rule, which every long-lasting professional trader repeats, is never risk more than 1% or 2% of your total capital on a single trade.
That sounds incredibly conservative, especially for new traders who want to multiply their money fast.
It seems conservative, but it's the only path to longevity. Let's use the water reservoir analogy. If your capital is a reservoir of water and you only risk 1% per operation, you would have to lose 100 consecutive trades to completely drain your reserve. 100. That mathematical certainty gives you incredible psychological resilience. A loss becomes a manageable operating cost, like the cost of gasoline for a car. If you can't tolerate the cost of gasoline, you shouldn't drive. If you can't tolerate a 1% loss, you shouldn't trade.
So risk is like a seatbelt. It doesn't prevent the accident, but it minimizes the damage to a tolerable level.
Absolutely. And hand in hand with that is position sizing. This is a purely mathematical calculation that tells you exactly how many units to buy so that if your maximum risk hits the stop loss, the loss stays within that predefined 1% threshold. It's what allows you to align your actual trade with your psychological pain tolerance.
That leads to a second actionable tip, which I love. Define your point of maximum tolerable pain before you enter.
If you hit your stop loss and you feel paralyzing panic, your position was too large. Reduce it immediately. If you hit your stop loss and you feel minor annoyance, like stubbing your toe, then your position sizing was correct. That feeling of minimal annoyance is the sound of a professional risk management system working perfectly.
It seems like discipline is the real key here. It's not an innate quality, it's a muscle you train daily. What kind of mental routines do the elite traders use to reinforce their control?
It starts with the art of disconnecting. A primary source of anxiety is overexposure, being glued to the screen, watching every tick, micromanaging the price. This turns you into a slave to micro-emotions.
That sounds exhausting. You're constantly reactive.
And it's a death sentence for long-term profitability. The global market is 24/5, but you are not. You have to set definite entry and exit times for the market and respect them religiously. Once your plan is in motion, give it room to breathe. Go for a walk. Read a book. Step away. Just as major institutions only release quarterly or annual reports because daily volatility doesn't reveal the real economic trend, you must step away from daily myopia to see the big picture.